Best ever listeners, how you doing? Welcome to the best real estate investing advice ever show. I'm Joe Fairless. This is the world's longest running daily real estate investing podcast where we only talk about the best advice ever. We don't get into any of that fluffy stuff. With us today, well, we have Theo Hicks, like he is always, well, usually with us on Follow Along Fridays. Theo, how you doing, my friend?
I'm doing great, Joe. How you doing?
I am doing well and looking forward to diving in today. So, best ever listeners, as a refresher, the purpose of Follow Along Friday is to talk about things that we are discovering and learning along our entrepreneurial journey so that we can share those lessons, those observations with you to help you along your real estate entrepreneurial journey. And today we're going to be focused on Theo's portfolio that he has chosen to sell. And last Follow Along Friday, he mentioned it and it surprised me. And I was like, well, we need to discuss this. I'd just love to learn more about the thought process. And we didn't have enough time last week, so we decided to dedicate today's conversation to that. So take it away, my friend.
Yeah, so I'll kind of just kind of give my general thought process, and then you can ask any follow-up questions that you would like. So, as most people know, because when I first bought these properties, we talked about them a lot on the podcast and kind of the issues that I faced and kind of how I overcame them. But just kind of to take a step back, when I bought these properties, my initial plan was
taking a step back even further real quick.
Yeah.
What are the properties? Like how many units? And just give us a lay of the land.
So they're 3 fourplexes, so total of 12 units. All 3 fourplexes are on the same street. 2 are right next to each other, and then there's like 2 houses, and then 2 houses in between, and then my other fourplex. And when I bought them, the seller was actually selling 5 fourplexes on that same street that were essentially all in a row. I think there was maybe 1 property in between. And I bought 3 of them, about a little bit under what they were listed for. And the good thing, because I think they appraised for the list price. So I kind of had built-in equity right away with the properties. Mm-hmm. But when I initially looked at them, based off of my understanding of that area, I knew that the rents were low. Even based off of the condition of the units, the rents were just too low. And so my plan was to go in, buy the properties, obviously, and not do any value add renovations right away, and just because all the leases were month-to-month leases. So I was going to go in there and just raise the rents to market rates. And then eventually, once I started to see other properties, start to upgrade their units with new appliances, new floors, things like that, then I was going to do that using the cash flow that I made during the year, 2 years that I was holding on to the properties after increasing the rents. Mm-hmm. And as everyone knows, that's not what happened. I thought that the properties did not have a high level of deferred maintenance because of the inspection that I received.
Boiler, gotcha. I remember that.
And there was the boiler issue, and then there was plumbing issues at a place, multiple stacks. So now obviously that involves breaking into the walls and replacing those cast iron stacks.
And what's a stack for anyone who's not familiar?
It's just the main sewage pipe in the house, where all like when you flush the toilet, when the tub drains, when the sink drains, it all pours down there. And these older cast iron pipes were not only themselves corroded, but there's all these twists and turns, and whenever there's a turn, all of the crap literally will pile up in there, and then so the hole gets smaller and smaller until it gets clogged and nothing can go through it. And so I had to replace multiple ones of those. And so essentially every time that I would make cash flow for a few months in a row, I'd have to end up spending all that cash flow to fix something up. So when I finally got to the point where the majority of the deferred maintenance was fixed up, I kind of had a decision of, okay, I can either now go back and renovate these units and increase the rents by $100, $150, or since I have been able to raise the rents, I can liquidate, pull out the equity that I initially put in, as well as the extra equity that I have and the money that I have saved up to buy one property. So one apartment, 20 units, 25 units. And kind of, again, it's not me whenever, but kind of my thought process behind that was, number one, I want to buy a property regardless. So it's either I'm going to have these 12 units that I'm going to have to take some of my personal money to fix up, which means that I have less money to buy another property that I would probably also want to fix up, and it would be, might not necessarily be right next to these properties, and so I'm going to have 4 or 5 or 6 fourplexes, kind of scattered across Cincinnati, as opposed to just having a 20 unit or 25 unit in one spot, and using all that money to fix up that property. So that's kind of my thought process behind it right now.
In terms of the numbers, can you give some concrete numbers for what option A is in terms of, like, if you kept it and you had put more money in, how much money all in would you be? And then option and any other relevant information there. And then option B is the option you're choosing to do. What is the property? What are the properties worth? What do you have into it? How much are you going to come out with it projected?
Yeah. So I bought them each property for $220.
Okay.
And I put 25% down. Everything that I've done to the property so far has just been using the cash flow from the property. So I haven't had to dip into my personal bank account yet to actually fund any of these deferred maintenance issues.
Okay.
Luckily I did account for, I had like 15 grand saved up just in case something happened, and something did happen instantaneously for the boilers. So once I had paid for all of that, I was able to just use cash flow to fix everything up. So so from my perspective, I still consider that myself in at 220 total, because I didn't have to come out anything extra. It was just from the cash flow. Maybe I should be considering it differently, but that's just kind of how I'm looking at it.
Uh-huh.
And then
so 220 per place?
per property.
Okay. All right. So 660 total.
Yeah. And then right now they're listed at 275. And assuming it goes around there, I would come out with between 45 down to maybe $30,000 per property. And then once you take away the commissions, let's just say 25 to 30 grand per property. So somewhere around 75 to 90 grand.
Mm-hmm. Yep.
And so, and again, I don't have,
right.
In profits. Exactly.
Profits, right. Yep.
And, but the biggest issue is that I would have to, because I could technically refinance and then use that capital to fix these things up. Or I could use my own personal capital, invest it into this property to fix them up. But, and I haven't done like any hardcore, like, okay, if I keep my, because something else we want to talk about too is kind of the thought process, the conversation we had yesterday about you selling your properties and kind of the cash on cash return of, what potential cash on cash return you could get with that capital by investing in something else as opposed to investing it into your property.
Mm-hmm.
And I haven't done that exact analysis yet, but mostly it's less to do with, because I'm assuming it's going to come out to pretty much the same. I kind of just want to get a property, and I don't have all my units in one property, and kind of have that be my strategy moving forward. So every time I buy a property, I can fix it up, whatever, raise the rents, increase the value in some form or fashion, and then liquidate and then upgrade to a bigger property. And so this next property I buy, I'm going to do the exact same thing. Mm-hmm. Something that I definitely want to talk about is some of the things that I'm going to do differently on the buy side. But when I actually, assuming that I put those into place, buy this 25 unit property, increase the rents. For this 25 unit property, the rents will actually, the value of the property will actually be dependent on the rents, which is not the case for these because they're residential.
Right.
Force the value there for 2 to 3 to 4 years, and then sell again and buy a 50 unit property in combination with money I've saved up and the money I made from the property. So it's less of, okay, I'm not, this deal that I have right now, if I invested money into it, it wouldn't be a good idea. Obviously it is, and anyone who buys it will be able to do that. It's more of wanting to kind of continue to get larger and larger properties and just have one property in one location.
Okay. With your a couple questions. One, with your 12 units, the three fourplexes, are you able to, uh, or are you currently packaging them as one opportunity and then pricing it based on a cap rate? Because I've seen people do that with a portfolio of single family homes.
That's that's essentially how I got to my list price. So I figured out what the total package would be worth, and then just divided it by three and have that be each of the individual property listings.
You figured out what the total package would be worth, but was that based on how residential is underwritten or using?
Using the net operating income and the cap rate.
Okay, what cap rate did you use? Do you remember?
I think it was I think it was 6 or 6.5. I can't remember exactly what it was, but it was 6 or 6.5, which is
Sounds like a good cap rate
yeah.
for you.
Uh, Yeah, well, I mean, I based it off of a few other properties that were very close that recently sold, kind of based off of their rent, assuming that their expenses are close enough to mine,
Mm,
and those ones actually sold. One sold for a little bit over 300, and that one had a stronger NOI than mine. And one sold for I think 240, and the NOI was a little bit weaker than mine. But the cap rate would be the same because they're all in the exact same little neighborhood in Pleasant Ridge.
mm-hmm.
And
Okay.
so, and then so I just asked your last question about the packaging. On each of the individual property listings, it mentions that there's like this is one of three properties that are sold, and you can buy all of them or individually.
Okay. Do you pay? Are you asking them to pay a premium for one, or can they buy one at the same price as if they bought two or three?
Yeah, just at the same price. And it's funny because when I was initially buying these properties, I was kind of thinking the same thing. Like, oh, if I'm buying all three properties, then maybe I can get them at a discount. But if he get, I mean, him selling unless
Well,
unless the
I
person's
was thinking the opposite. It wouldn't be a discount if you buy all three, but there would be a premium if you just bought one or two.
no, I don't have that.
Okay. Just as a relevant note, you should post this in our Cincinnati meetup group. The three deals. Um, why? So my next question is, you're currently, so taking a step back, your focus is on apartment syndication. Yes.
Mm-hmm.
Okay. Why buy a 20 unit versus just keeping this cash and then using it to put into the deal that you do when you syndicate a larger apartment community?
I will. I'm not going to use all the money that I have to buy. That's because I could probably buy like a 30 or 40 unit, but I don't buy. I still want to have, and obviously for personal reasons, like 6 months of personal expenses saved up just in case something were to happen, and then we're going to keep at least our minimum investment amount for our syndication in our bank account, so that when we find a deal, I can invest in that deal as well.
Okay. All
And
right.
and it's I wouldn't necessarily say it's for diversification reasons. It's just I maybe it actually is, but I do want to have kind of my own properties on the side for kind of not necessarily retirement, but just to kind of continue to build that up on the side. Because I mean, from my experience with these 12 units, it doesn't take as much time as long as I'm not managing them myself. It just takes speaking with your management company every single week, for half an hour to an hour to make sure that everything is operating smoothly. Of
Right.
course, it's after you actually buy the property, and since I'm only buying properties every 1 to 2 to 3 years,
Mm-hmm.
that time investment is fine, and it won't really take away from my spending time on apartment syndication. I kind of just want that to be my 401k in a sense.
Mm-hmm. Okay. And then the third thing is what you and I talked about yesterday when I called you up and I said, Theo, I'd love to get your opinion on how to think about this. And the scenario is the three single family homes that I own, and one of the homes is coming up for a lease renewal, and the property management company did an inspection of it, and it needs some help. there's some like they've got a dog and he chewed up all the outdoor wood frame area because apparently he wanted inside, but they weren't letting him inside. And there's a couple other things that need some loving. So, and I, whatever, invest in it and fix it up. I mean, it's fine with me. I'm looking at it from the long-term standpoint, but is it the best approach to continue to rent those homes out when there's trapped equity in each of those three homes? And I've mentioned the numbers before on the show. I'll just quickly mention them again. The homes are about 175,000 each. They're worth about 175,000. So in total, $525,000. And I have $157,000 in debt on them. So that's about $368,000. Let's just say fixing them up, broker fees, blah, blah, blah. I could probably net $300,000. So I'm removing $68,000 off the top. So I have about $300,000 trapped equity in each in total from those three homes. So I came to you yesterday and I was like, hey, how would you think about this? And you went through an interesting thought process. So can you just talk about that a little bit and what we discussed?
Yeah, so kind of how I thought about it was you've got a certain amount of equity trapped in the property that you could technically pull out and invest in something else and get some sort of return. So you can get something to kind of figure out of something to think about when you're kind of looking at a situation is, okay, so I've got this equity. What return am I currently making on that equity right now based off of whatever cash flow you're getting per month? And we came to the conclusion that, and this is kind of this would be the selling scenario, based off of how much equity you'd be able to take out if you sold, based off of, and then also based off of how much cash flow you're making per month, it would be about a 3% cash on cash return.
Yeah, because right now the three homes year to date, well, actually through March, so the first quarter of the year, they made, he said $2,300, and 2,300 times 4, yeah, it's $9,200 for the year that they're on pace to make. So you divide that by 3 homes and you divide that by 12, they're making $255 a month, each of the homes on average. So you said, okay, well, that's $9,200 a year divided by the trapped equity that you have in it. Which is 300,000. That's a 3.07% return on that trapped equity. Not so good. Can you do better than that? And I was like, well, yes, we can do better than that when I take that 300 and invest it into our apartment syndications that I'm doing. And so then it made it crystal clear to me that, okay, I need to make a move on these homes. The other option is to refinance. And when I refinance these 3 homes, talking to the lender, could probably get about $100,000 out from the homes. But then I've got a bunch of paperwork. I'd have 3 different loans. I'd have to go through the process. And my financials are not easily understood by banks. So there's a long process that it's just a headache. And if I can just rip the Band-Aid off, and not that, I don't want to be melodramatic. This is a quality problem to have. So I guess I shouldn't say that way, but if I want to resolve what I'm trying to resolve, then I think just sell each of the 3 and then take that money. And so then the question is, do I 1031 into something that you're discussing, a smaller deal, maybe like, I don't know, a $600,000, $800,000 property, or do I just bite the bullet, pay the capital gains, and invest the difference in one of our deals? And I'm on the opposite side of the fence from you. I never want to have a 20 unit or a 30 unit or a 40 unit on my own, ever, ever, ever. I want to just pump that money into our deals, because I don't want to be on those calls every week discussing a 30 unit. I have no desire for that at all. So I won't be doing a 1031. I'm just going to bite the bullet, pay the long-term capital gains, and then pump it into our own deals.
Yeah, so I did the same exercise for my properties, and the ROI that I'm making on that trapped equity is around 4 to 5%, which I know I could. And again, I mean, I know I could technically go into this scope, I can nerd out and be like, okay, well, what if I put in more money and I'm able to increase the rents? Now what's the trap? Now what's going to be the NOI, or sorry, the cash to cash return based off of the new trapped equity and the new income? And it might be a little bit higher, but that's going to take time. And I'm kind of going to be in the exact same situation with those properties that I would be with just kind of buying a brand new property. And I know something else I mentioned was something on the buy side that I definitely need to do. And I know I've talked about this before, but just to reiterate, I really need to be a lot more detailed on my due diligence on the physical condition of the property. So I need to not just look on the kind of the outside, and not outside, not like extra the property, but like very surface level, like, oh, like this looks fine. I need to I've got certain things that I know need to be looked at in greater detail, and I can't just pass those up. I can't just assume the inspector knows what he's doing. When I'm with the inspector during the property during the inspection, I need to be like, all right, well, like, can you please take a deeper look at the boilers, for example, or can you please take a deeper look at the plumbing in the basement, and kind of let me know based off of what you see in the basement, how would you interpret the rest of the property's plumbing? So things like that I definitely need to do up front, as well as it's so funny because I don't think I was as involved with underwriting for apartment deals when I bought these properties. I don't think I was, because I definitely did not have our cash flow calculator at that time, because I did not use that cash flow calculator to underwrite, and so my underwriting was not as detailed either. It wasn't 50% rule and that was it, but it wasn't definitely not detailed enough, and I was not thinking about it properly. So now I've gained so much knowledge in the past 2.5 years since I've owned these properties in regards to the underwriting process, and so I'm very, very confident in my ability to find a much better deal, in a sense of buying a much better deal on the front end after I actually do proper underwriting and then proper due diligence.
I think there are a lot of lessons, and I'm grateful that you brought this up and we talked about it.
Yeah, and once I actually sell the property, I'd definitely like to go into more granular detail on it. But so once I sell the property, I can talk about the numbers specifically, and then talk about more lessons that I learned, and then things that kind of my plan for moving forward. Alrighty, trivia question time. I always enjoy finding these trivia questions. It's a fun exercise.
And I enjoy getting the answers wrong every time except for once.
So last week's question was more of like a fill in the blank. It was 1 out of 3 Fortune 500 companies are headquartered in this many markets, this many MSAs, specifically metropolitan statistical areas. I think you said 3 or 4. I think you said 3. The answer is actually 6. So I think it was 180 out of the 500 are in 6 MSAs. And those MSAs are, this is from lowest to the least to most Fortune 500 companies. San Francisco was 6th. Minneapolis was 5th. Houston was 4th. Dallas was 3rd. Chicago was 2nd. New York City was 1st.
Minneapolis, sneaky.
That was surprising.
I wouldn't have put them on that list. I was just there to see Texas Tech almost beat Virginia about a month or so ago, and I had no idea they had so many Fortune 500 companies.
Mm-hmm.
Huh.
And keep in mind that it's not just the city of Minneapolis; it's the MSA, so it includes St. Paul.
Yeah, right.
San Francisco includes all the places surrounding it. Okay. So that was the answer to last week's question. This week's question is: in 2018, the total number of jobs nationwide increased by about 1.8%. The question is, how many markets, MSAs again, experience a job growth of greater than of 3% or greater? So with the national average being 1.79 exactly. how many markets, MSAs, experienced job growth of 3% or greater?
How many total MSAs are there in the U.S.?
That's a good question. I do not know the answer to that.
Approximately like 300. Well, you don't know, so
I can't even give you
I
a
guess
guess.
he asked the same question, but you're still gonna have the same answer, right? All right, I'm gonna say 4. I don't know. I don't know even where to begin with that one.
All right. So as always, you can submit your answer to the question either in the comments of this YouTube video, or you can email info@joefairless.com. And the first person to get it correctly will receive the signed copy of our first book. Lastly, we're going to do the review of the week. So if you purchase the best ever apartment syndication book on Amazon and you leave a review and send us a screenshot of that review, you will have not only will you receive a link to download the free apartment syndication documents and resources that we have available, but you will also have the opportunity to have your review read aloud on the podcast. This week's review was actually submitted via Facebook. It was from Corey Boatwright, who actually took a selfie with the book, and he said that he said phenomenal book, Joe Fairless, and he posted that on Facebook.
Yeah, Corey, thanks so much for posting on Facebook and tagging me and all the comments from all your friends and the interaction. I really enjoyed it, and it reminded me that I haven't interviewed you in a while. I saw Corey at the conference, Best Ever Conference in Denver, and so looking forward to that interview that we're going to be doing. And then on a separate note, but related to what we were saying, there are 383 MSAs in the United States. Guess how many there are in Puerto Rico, real quick?
0.
7.
7?
7 MSAs in Puerto Rico, yeah. Happened to be in the same Google search, so that's why I mentioned it. Well, best ever listeners, enjoyed hanging out. Hope you got a lot of value from today's conversation. Have a best ever day, and we'll talk to you again tomorrow.